Every bank in America tells you roughly the same story. Partner, community, here for you. Your financial future starts here. Walk into any branch, open any app, and the language is warm, reassuring, consistent. Your bank is on your side. Then the statement arrives, the fee appears, the loan gets denied, and somewhere between the promise and that moment, something stops adding up. By the end of this video, you'll know the exact dollar amount that decides whether your bank charges you or not. A federal rule protecting your deposits that got quietly erased in 2020. Almost nobody's heard of it. And why put your money in savings might be the worst advice anyone's given you in the last decade. That last one isn't a scare tactic. It's math. Stay with me. Let's get into it. The line nobody tells you about. Here's the promise. A bank organizes your money, grows it, and gives you access to credit when you need it. A home, a business, an emergency. At a fair rate. Beyond that, it's supposed to reinvest your community's deposits back into your community. Fund the mortgages. Fund the small business loans. Be an engine, not just a vault. For some customers, that's exactly what happens. Good rates, low fees, real partnership. For everyone else, the experience runs through a number almost nobody talks about out loud, somewhere between $1,500 and $2,500. That's the minimum balance most major banks require before they'll waive your monthly maintenance fee. Notice what that means. The customers who can already keep that much sitting untouched and checking don't need the fee waived. The customers who can't are the ones getting charged. That's not a glitch in the system. That's the system. And overdraft fees alone pull tens of billions of dollars a year out of the accounts of people who can least afford to lose it. So if the promise is partner, ask yourself who's actually being charged for the relationship. The advice that's quietly losing you money. Now here's the one that surprises people. You were told, save your money, let it grow, be responsible. For most of the last 2 decades, the average savings account at a major bank paid interest so low it was almost insulting. Under 0.1% for years after 2008. $10,000 sitting in savings earned you about $10 a year. Less than lunch. But even the better high-yield accounts you'll find today, paying 4 or 5%, run into a number that decides whether you're actually getting ahead. Inflation. When inflation matches your interest rate, you're breaking even. The balance goes up. What it buys stays flat. When inflation beats your rate, which it has for most of the last 20 years, your balance climbs while your actual wealth quietly shrinks. A family that saved $20,000 over a decade at 0.5% interest, with inflation running 3%, lost ground every single year. Balance up, wealth down, and the people following the safe advice hardest, the ones with the least room for error, are the ones absorbing that loss the most. Meanwhile, the money that isn't stuck in savings, the wealth already sitting in stocks, real estate, and market accounts, compounds right past inflation year after year. Same system. 2 completely different outcomes depending on which side of it you started on. And that's before we even get to the part that should really bother you. The rule that disappeared with no announcement. For decades, the Federal Reserve required banks to keep 10% of certain deposits on hand as reserves. Every $100 you deposited, 10 had to stay put. It wasn't a perfect protection, but it was a floor. A basic guarantee that the bank couldn't lend out every dollar you gave it. In March 2020, The Fed cut that requirement to 0%, not 5, not 2, 0. American banks are technically not required to hold any portion of your deposits in reserve. The official reason is that other rules, capital and liquidity requirements, cover the same ground now. And there's real technical merit to that inside banking regulation. But from where you're sitting as a depositor, here's what actually happened. A rule that protected your money got erased with almost no public debate and almost no coverage. This didn't come out of nowhere. It's been the direction of banking policy for decades. More flexibility for the institution, quietly, one rule change at a time, and more risk absorbed by the person who never got a vote on it. If any of that lands different than you expected from your own bank, hit like, subscribe so the next one finds you, and send this to someone still blaming themselves for a fee that was never about them. When the bank says no, and when the bank isn't even there, banks advertise credit as a tool for growth, a home, an education, a cushion in a hard year. For customers with strong credit and steady income, that's mostly true. For everyone else, loan denials come down to metrics, credit scores, debt-to-income ratios, collateral, that are themselves harder to build the further behind you're starting. It's a closed loop. You need credit to build credit, and the system that's supposed to help you start is the same one deciding you haven't started enough yet. We're going deeper on exactly how that scoring system works next episode. For now, just notice this. The institution that calls itself your financial partner is often the one saying no when you need it most. And the no gets explained as risk management instead of what it actually is. A business choosing not to serve you. And for millions of Americans, the bank isn't even a choice to make. Thousands of branches have closed over the last 2 decades. Online banking, mergers, and a cold calculation that branches in lower income and rural communities aren't profitable enough to keep open. Researchers call these banking deserts. When the bank disappears, the need for banking doesn't. Check cashing stores and payday lenders move into that space instead. And a family cashing every paycheck at one of those can lose thousands of dollars a year in fees alone. That's not a personal failing. That's the cost of your zip code deciding not to serve you. There was supposed to be a fix for this. The Community Reinvestment Act of 1977 requires banks to meet the credit needs of every community they operate in, including lower income ones. In theory, real accountability. In practice, most banks pass their reviews with satisfactory or outstanding ratings, and banking deserts persist anyway. Fee structures that punish low balances persist anyway. Something in that math isn't adding up, and it isn't your math that's wrong. So here's the question. The promise of banking, safety, access, partnership, reinvestment in your community, isn't a bad promise. It's actually a picture of what a financial system built for everyone could look like. The gap between that promise and what millions of Americans actually get wasn't an accident. It was built, fee by fee, branch closure by branch closure, rule change by rule change. In policy rooms, most depositors will never see. So the real question isn't whether banks are capable of keeping their promise. Credit unions and community banks prove every day that they are. The question is why we've spent decades treating the gap as normal. Next episode, we go inside the system that decides who even qualifies for that promise in the first place, the credit system, and the catch-22 that keeps everyday Americans locked out of it. Click the next video. Once you see how the score actually works, you'll never look at that 3-digit number the same way again.